The things I've learned for me personally is really find your investor DNA, make it small, make it detailed to your own risk tolerance and what assets do you like. Multifamily in the Midwest, like that's what I like now because it's stable. Even in 2008, multifamily in the Midwest didn't really crash like everywhere else did. Find your investor DNA. I have learned my lesson. I've invested with an operator. It was basically a referral from a guy that I trusted, and this was 5 years ago now. It ended up being a Ponzi scheme. Well, the guy that I trusted, he got burned too. After that deal, I realized, all right, now every deal I get into and get investors into, especially, I am walking that property myself. I'm looking at everything. I'm shaking hands with the operator. I'm knowing who that is. Trust is such a big factor, and aligning with that main operator is a great thing too. Understanding their mission, understanding their values, understanding how much money that operator has in the deal as well. Being able to shake their hands, look them in the eye, know who they are personally. Those are all massive things.
You're listening to Tax Savvy, the art and science of keeping more money in your pocket. Each episode, we uncover specialty tax strategies, share expert advice, and talk through practical insights businesses use to stay ahead. Whether you're here to learn more about specialty tax or just want to make smarter money moves, you're in the right place.
Hey everyone, this is Craig Fouts at Align. Welcome to Tax Savvy. Today we are joined by Kyle Stephenson, the one and only. Really appreciate having him on today. I'm excited for our conversation. So Kyle, thanks for coming on.
Yes, thanks for having me on, Craig. Appreciate you.
Yeah, so hey, wanted to return the favor. So previously went on your podcast and we had a lot of exciting real estate and tax talk. So definitely want to bring your perspective to our podcast and getting some really fun stuff today.
Yeah, we appreciate it. I know. It was a great podcast. My listeners love talking about taxes. So this would be nice to be on yours, and let's return the favor.
Exactly. I love spreading the knowledge and then not only saving people money, but just helping them build their long-term wealth as well, using a lot of the tools that we offer at Align and a lot of the knowledge and things that you're able to apply with, you and your group and how you help people as well. So, to kick things off, would love just to hear a little bit about your background so everyone knows, and then transition how you got into real estate and, been so educated on tax too.
Yeah. So I'm an orthopedic surgeon here in Indianapolis. And, I got out of practice, or I got into practice in 2018. And it really wasn't until around 2020 that I figured that we had a tax problem. Like as physicians, I think, maybe it took COVID, maybe it took, me being an orthopedic surgeon, they said you need to stay home during COVID. So I had more time to start doing my due diligence and learning about different things. And again, realized we had a tax problem. How do we do something about that? I'd say for me, it started understanding Robert Kiyosaki, reading about that during residency, seeing, you can buy assets, you can buy liabilities, and realizing that I want to be the guy that buys the assets. And, but I didn't really know what all that was about until I started diving into real estate, tax benefits of real estate. And, again, that was 2020. And so now fast forward 6 years, I've learned a great deal these last 5-6 years.
Yeah, absolutely. So, and, I think you are probably like a lot of people out there that they want to go get into investing in assets, maybe not sure where to begin. They know there's tax benefits that goes along with, especially with real estate, but you just have no idea even where to start, right?
Yeah.
And then you start reading about it, and then it just gets more confusing, right?
It's true.
Yeah, right. So, to start with, didn't you buy like a couple rental homes to start things off, right?
Yeah. So in 2020, I was actually an LP on deals. So, I was just an investor to start. My financial advisor was like, hey, we got some real estate you can invest in, put $50,000 or $100,000 in the deal. And I really had no idea what I was investing. I didn't know much about it. I didn't know where my taxes losses were coming from. I didn't know anything. I just knew I trust this guy. I'm going to hand my money over. And it wasn't until I had a conversation with one of the operators I was investing in. He came to me and he said, hey, man, can you get more doctors investing in these deals? And I was like, yeah, I can. And he goes, we learn about the sorry, I got kiddos. He said, we've always learned that the best capital comes from the 3Ds, doctors, dentists, and dumbasses. And I was like, a light bulb went off in my head. like, man, we're in the same category as, excuse my language, but a dumbass in their mind. And I realized that that was actually accurate. I mean, in medical school and residency, we don't learn anything about finances. We know nothing. We literally just study medicine and that's it. So then we come out into practice, you make pretty good money, but you're taxed on half of that. 35% from that goes to interest, on your mortgage, credit cards, student loans. And then you're really left with like 25 to 28% of the money you made to live and invest. And that hit me hard. And so that's when I really started diving deep. I bought, LP at first, then I bought my first property in 2022 and learned a ton of lessons from that. Did a BRRRR, bought it for cheap, renovated it, put a renter in there, and learned a lot of lessons. But I realized that didn't really help my tax game, a little bit. But there's the short-term rental that was a lot better. There's the short-term rental tax loophole. But the thing that really struck me was when I learned about the reps status. So my wife is a stay-at-home mom. Harder job than anything in America, yes. But I realized that if we built enough portfolio for real estate, she can run that portfolio and get to 750 hours, become real estate professional status, and really offset my W-2. So I can still work hard and then get a nice, refund at the end of the year.
Yeah, absolutely. So I think you stumble upon, again, like a common issue a lot of people do, where they invest and then they think it automatically offsets their income from running a practice.
Yes.
Or their W-2 or whatever, right? Let alone, of course, the tax code, is confusing it is, makes it very clear that real estate is typically passive, doesn't offset your real estate, or your W-2 unless certain circumstances are there. And you nailed 2 out of 3 of them. Right? The short-term rental and then also rep status. So it sounds like you've got to take it one step at a time until you've been able to fully unlock utilizing real estate to its full potential. And the second piece there too, is that kind of how, Doctors Investors Club started off, where, you were maybe asked to go look for other doctors to invest in, and then you realized, hey, there's something here. Like there needs to be a real education piece to help, people in my industry out.
Yeah, good question. I do think there's a lull in education, yes. And there's one group called the White Coat Investor, and he's good. I was on his podcast, and we all read his book in residency and medical school. But I was also reading Robert Kiyosaki on the side. I realized he was like the Dave Ramsey for physicians, and I wanted more of a Robert Kiyosaki for physicians, and we didn't have that. And so I started a podcast myself 2.5 years ago. When I was learning about real estate, I was like, more docs need to know about this. And that was called Assets and Orthopedics. And, you can get guests on, like I would reach out to people and they'd come on the show and they want to talk about themselves. And it was great. And I learned, more than even the listeners, right? And so it was more probably for me than it was the listeners. But I reached out I heard a guy on a podcast, Richard Wilson. He's the CEO of what's called the Family Office Club. And, I heard him on a podcast and I thought he was brilliant. So I just reached out to him and just said, hey, could I, ask you a question about this? And he responded basically right away, and I couldn't believe it. And he's like, hey, if you're ever looking for a guest on the podcast, I'd love to come on. I love doctors. Excuse me. So he came on my podcast, and basically I told him what I was doing. I'm trying to, educate physicians to think less like the middle class and more like the wealthy. The wealthy understand the tax game. They understand that taxes are your biggest expense. Doctors don't necessarily do. I don't want to generalize for everybody, but for the most part, doctors are in that boat. And so he's like, well, I have this thing called the Doctors Investor Club that I need a really good doctor or a doctor that wants to be out there, to help me promote this thing and lead it. And so that partnership just really formed that way. And it's been great. It's only eight months in the making now, but we're growing it. I go to speak at his events. He puts on 16 to 18 live events a year with billionaires, decamillionaires, centimillionaires. And now we're bringing doctors into that room. And so I go speak with him. And then he also has a bunch of AI tools that help us do due diligence on deals and really just to help us think like the wealthy. I mean, that's really what it comes down to.
Yeah, there's always one quote you say I absolutely love is, it's not how much money you make, it's about how much money you keep. And that's exactly how it is. You got to understand the tax game and other strategies to keep as much as possible rather than try and grow that top line as much as possible, right?
Absolutely. Yeah. I mean, the IRS tax code is really incentives for people to save money in taxes. So I think it's like 5% is to tell you what not to do, and 95% is like, here's what you should do to lower your tax rate. So it's really legal, ethical, and American to do it. And it's really just finding the nuances of it, and it's talking to people like you and smart experts in the field, CPAs, to really understand the nuances, because that's what a lot of docs just get confused. Social
Yeah.
media promotes a lot of things, and so we want to we're trying to clarify things, through my podcast and through meetups and education and all that.
Yeah, and I think a lot of people try to dive in to the tax code, and it's basically a black hole. It's just a maze, and they try to learn everything themselves. And rather than just reaching out to people like you or me, we can help it simply explain it to them, right? So, as are trying to educate, these other doctors, physicians, whoever, where do you begin with them? Is it step one? Hey, look at your financial picture, and then we'll figure out, what you need to do tax wise in your situation, or really, where do you begin with people like that?
Yeah, I mean, first and foremost, get organized,
Yeah.
with your own finances. A lot of people don't even understand that. It's like, if you have a business, then you have to understand your P&Ls, right? Your income statement. But most physicians don't realize that they are the business. And if they don't have their own P&Ls or their own income statement figured out, then it is hard to figure out where to go from there, right? So you can't change what you don't measure. So first of all, do that. Second of all, have a CPA that is not just crunching your numbers at the end of the year. April 15th comes around and it's like, all right, what did I do? What's the damage? It's like, no, prepare this year for next year. So that's one thing I've changed over the last, probably 3 or 4 years. I started strategizing with my CPA, obviously reading the books myself, but then I strategize with him 4 times a year at least, and figure out what I need to do for the next year. So then I'm not only not surprised for the next year, I'm actually like, I'm so proactive that I know what's coming back my way. And it's been brilliant. And the truth is, like, again, taxes are our biggest expense. There's no question. And once you get started in real estate, it's, figuring out what's best for you. I mean, I think the best way to do it is reverse engineer. If you really want to save on taxes, don't just go buy a single family home. Like, figure out what's going to be the best way to minimize those taxes. And then the other thing is to strategize with your CPA. Just understand what's right for your situation.
Yeah, absolutely. So, as people are starting to maybe look to get into real estate, right? They're organized. Step one, they have some money, they want to start investing. There's so many just different syndicators and real estate groups out there. What would you really recommend for people to have conversations with? Number one, make sure they are legitimate. Um,
Yep.
and how would you go ahead and educate them how to make sure it is a good deal for them? I know that's kind of a loaded question, but
It's a good
really,
question.
there's some scary stuff out there where you hear people losing deals or having to refine or regroup on capital because the deal didn't go the way it should, and that's the last thing you want as you're trying to build wealth, is to get into a bad deal. So where do you always help people there, or how do you start people there?
Yeah, it's a good question. And I mean, even just to start, like, I started buying my own properties, and started small and then started scaling and becoming GP on deals. And when over this time, I've learned that being an LP on a deal is the best thing you can do, only because you don't have to do a whole lot. Like, being a landlord is rough, getting the phone calls and, fixing the toilets, tenants, dealing with tenants, termites, trash, all the things. It does become rough. And so it's not a passive thing like the IRS thinks it is. It's very active. So, to your point, being an LP on a deal is a great way to build wealth and do it smart, intentionally, and get some passive tax depreciation. Um, I've learned probably the hard way. I mean, I early on I just started. There was a shiny object everywhere. 5 6 years ago, I'm like, oh,
Yeah.
deal looks good. That deal looks good. This one was referred by somebody, and I truly did not know how to do due diligence on a deal. I just read the pro forma, thought it looked great, and then realized, maybe from 2009 to 2019, that worked because pretty much everything did well. But then once 20 hit and 21, 22, rates shot up, you realize that a lot of people actually didn't have good deals, and their deals got very compromised quickly because of that. So the things I've learned for me personally is really find your investor DNA. Make it small and make it detailed to your own risk tolerance to see. All right, and then the other thing. So investor DNA, risk tolerance, and what assets do you like? Multifamily in the Midwest, like that's what I like now because it's stable. Even in 2008, multifamily in the Midwest didn't really crash like everywhere else did. And so find your investor DNA. I have learned my lesson. I've invested in a deal in Savannah, Georgia, and it's like delinquency's going up and it's not stable market because it's on the coast. I've invested with an operator that was it was basically a referral from a guy that I trusted, and this was 5 years ago now. It ended up being a Ponzi scheme. Well, the guy that I trusted, he got burned too. And so after that deal, I realized, all right, now every deal I get into and get investors into, especially, I am walking that property myself. I'm looking at everything. I'm shaking hands with the operator. I'm knowing who that is. And even then, trust is such a big factor, and aligning with that main operator is a great thing too. Understanding their mission, understanding their values, understanding how much money that operator has in the deal as well. Being able to shake their hands, look them in the eye, know who they are personally. Those are all massive things. And then lastly, I'll say with the Doctors Investor Club, for any physician listening, physician or dentist, we have what's called a Dewey due diligence AI tool, and you literally can feed your performer into that or pitch deck into that AI tool. You can feed the operator into that AI tool, and it will do full due diligence on the deal and them to tell you, is this a good deal? Is this a good operator? Have they had bad track record? Is it a good track record? Whatever that is. So for me personally, I've learned the mistakes. I realized don't only find, the asset you want to invest in, but the operator is the bigger part of that. And do they align with your own values? Do you know them personally? Have you shaken their hand? Have you looked them in the eye? Do you truly trust them? And that's really the key for me.
Yeah, absolutely. That's awesome about the AI tool. So that's, do you guys just come out with that recently?
So, if you look up the Family Office Club, again, Richard Wilson, he's got 40 AI tools. And with that due diligence AI tool, he actually took 150 white papers on due diligence and compiled them into this AI tool. So it's not like it's information from Google or Wikipedia. It's literally high level stuff. He's got other AI tools. He takes all the billionaires that he's interviewed, all their public interviews, all their books, every billionaire, and he put that into an AI tool. So you can get advice from billionaires now. It's really neat what he's done. And again, physicians have free access to that when they join our club. So pretty neat.
That is pretty neat. So, but back to when people are investing too, maybe on an LP for a deal, I guess what's the cycle there? How do people build wealth, right? So they always advertise year one losses, of course, right? That's a big benefit of it. But what happens from there, right? Do you continue just to cycle in deals or find more deals, or how do you go ahead and do that to continue to multiply that money?
Yeah. So, it's a good question. And, if I say anything wrong, please stop me and correct me. But the way I understand it, the way I do it is we invest in a deal, say it's a 5-year deal. Now with 100% bonus depreciation, the group will do a cost segregation. So I'll use an example. We have one. I work with a team called Hudson Investing now. Love them. I align with them. Known them since high school. And we have a deal coming up, 5-year deal. Say I put $100,000 into it. We'll do a cost segregation. We'll get the 100% bonus depreciation in the first year. And that's going to throw off 55 to 70% passive income that you can take as a loss against your passive depreciation you can take as a loss against your passive income. And we've already had a bunch of deals these last 5 to 6 years. So we have a bunch of passive income that has accrued. So we can take that and offset it. And then you get cash flow basically starting Q3 of this year. We'll start getting distributions, quarterly distributions, and you'll get those for 5 years. And then at year 5, they'll sell. I mean, you could do a cash out refinance, which would be awesome. You do that and pull your money out tax deferred, basically. But they'll likely sell in 5 years. And if they do, you get your capital back, that first 100K, tax free, and then you'll be taxed, capital gain tax on the profit. We're expecting a 2x, so the second 100K will come to you with a profit. That will be taxed unless you have passive depreciation already accrued from before.
Sure.
And then the other thing I like to do is just take that profit and invest it in another deal within the same year. And essentially that passive depreciation from the next deal will offset what I just made on the previous one. And that's a way, I call it the lazy 1031 exchange. Some people call it 1031 light. But it's a way to not have to do the full on 1031 exchange, which seems arduous, and still get a lot of the benefits and just keep kicking that can down the road.
Yeah.
So you don't have to, pay those taxes back, essentially, recapture.
Yep, exactly. So using depreciation to offset those gains you have and just continue to snowball and build,
Yep.
right? So defer, die. That's the strategy, right?
That's it.
Yep. So, yeah, that's awesome. You mentioned the cost segregation studies there too. The Hudson Group's great. So they've been awesome to work with, and Kent and Curtis are just great guys. So,
Yes.
But yeah, that's, I would say, most groups like that, they use depreciation to help offset and create those losses. There's some other similar tools out there, but really that's where those come from, and groups like myself to help come in and do that for them. So it's a fantastic tool to help continue to build wealth. You mentioned one thing or two is just passive too. And that's just one thing I always want people to know when they invest in those, is just to make sure, okay, do you have other passive income you can offset here? Or you can have future passive income to offset down the line. If not, doing this for a loss may not make sense, right? And you always mention too, don't let the tax tail wag the dog.
Mm-hmm.
Don't do things for the tax loss, but do it for the investment. So again, that goes back to what you were saying about the operator. Make sure you're going to have that 2x return. And at the end of the day, if you want to pull out and you have a nice healthy gain, that's all right. But just know you're probably going to have to pay some tax on it unless some other strategies are in place. So pretty cool stuff, man. It's just so cool. It's awesome to see what you're doing, helping educate people, building the community, and just utilizing resources like real estate and other investment opportunities. I guess what is, as we're going to wrap this up pretty soon here.
Yep.
What's, one piece of advice or something you'd really want to give to someone who's maybe looking to get into real estate or already in real estate that they should utilize to grow their portfolio?
First of all, educate yourself, listen to podcasts like Craig's and mine, and educate yourself first. But I think even better than that is, go to a local meetup in your town. And that's really the best way to just get immersed in it. And so, you talk to other people that are doing it. And the last thing really is have the end in mind. So reverse engineer what you're trying to do. If you're really trying to do real estate for taxes, which most people are, then understand what's going to give you that tax benefit. If you just go buy a single family home, maybe 2 or 3 of those that are long-term rentals, you're not going to get much tax benefit out of that. So, and then if you're going to do it Airbnb, because you're going to get the short-term rental tax loophole, make sure it's in a city that's not going to change their laws and change their rules and say, oh, you can't do short-term rental anymore, because a lot of cities have actually done that these last few years. So, it's really educating yourself, but reverse engineer it. Talk to your CPA and say, am I doing the right thing? And then take action.
There you go. I love it. Yeah. I would say too, not only with the reverse engineering too, understanding your commitment as well, right? So for example, if you're going to buy a short-term rental, know the requirements that go into that, the 100 hours, you have to be a material participant, things like that, and know that there is going to be some commitment. So make sure you're able to do that. Right.
Great point. It's a great point because it really is a business. So if you're going that short-term rental tax loophole route, it's a new business that you're starting. It's not just a little side gig. It's a lot of work to get those 100 hours. And, you may be the one cleaning. You may be the one, you're going to be talking to tenants. If you just hire a property manager for your short-term rental, then you're not going to get the hours. You're not going to get more than everybody else. And so then it doesn't make sense.
There you go.
For us personally, my wife's rep status now. So we do have a property manager running our Airbnb, but that makes sense for us. 3 years ago, it didn't.
Exactly. So know your situation. So surround yourself with experts and let them advise you. Don't try to do everything yourself. So
Absolutely. Yeah. I mean, one last thing I'll say to that, it's okay to be the dumbest person in the room, right? Like go to rooms that are people that will elevate you, that are smarter than you, and that will lift your game up. That will help you grow into this business.
exactly. So, but yeah, real estate, amazing opportunity to continue to build wealth. There's so many different ways to do it. There's so many tools out there to help out with your taxes. So it's really cool just to kind of hear your story, what you're able to do, some of the strategies you utilize to help offset your income. So really awesome to have you on the pod. So love the conversation, Kyle.
Yeah, absolutely, man. It's always good talking to you and see what you guys are doing, man. I'm excited for you guys. But yeah, this is great.
Yeah, I just want to say thank you. You've been a fantastic partner to us, and hopefully we can return the favor. Hopefully sometime soon here.
Absolutely. Yep, this is good.
Perfect. Well, thanks, Kyle. Yeah, have a great one.